Over several videos now, we've explored why you can't use past data to prove what the market will do in the future. We've looked at history, we've looked at logic, and it seems obvious that just because the broad market has gone up by X% over the last 100 to 200 years, that in no way guarantees what the future holds for investors. But accepting that reality would invalidate the go-to investment strategy parroted by almost everyone in the financial industry. So why am I the only one talking about it? Or at least why are there so few of us? Well, actually, the answer to that is pretty obvious. Here, check it out. Welcome back, you beautiful 18,000 subscribers, especially you, tuning in to this video. That was smart. You care, you're responsible. That's good to see. There's really not enough of that in the world. And you see, I'm afraid that before the mainstream comes around to these realities that we're exploring here on this channel, it'll be too late. Here's what I mean. It isn't hard to imagine how pundits and academics would react if the stock market were to drop by 50%. Stay the course, they would say. History proves that it's the right thing to do in a precarious situation like this. Your trusted advisors, too, coached in how to handle emotional clients and pumped full of the same Kool-Aid, would provide words of comforting wisdom during these troubling times, just as I used to, as I was trained to do. They point to past performance to prove that the market always recovers, a forward-looking conclusion drawn from limited backward-looking data. What would you do? Let's take this seemingly bizarro scenario one step further. Imagine the market never recovers during your lifetime. What if the market stayed below that 50% cut for decades to follow? You were 30, 45, 60 years old, whatever, all devastating when it began its descent. You waited for it to come back. You were strong and responsible. You stayed the course. You believed your financial advisor's rules of thumb, waited for the 8% average annual market return, and relied on their 4% safe retirement withdrawal rate. But this time, they were wrong. Here you sit, 30 years later, surrendered to a new paradigm. On occasion, albeit rare, the market might not go back up in a lifetime. Improbable? Perhaps. Impossible? Absolutely not. How can we be so confident in modern portfolio theory, that stock and bond buy and hold approach? Are we so secure and comfortable as to not at least prepare? Is this idea such a stretch in your mind that it should warrant disregard? Forget the depressing hypothetical then. The story of Japan's stock market provides a reality similar to the scenario posited earlier. From 1949 through 1989, the Nikkei 225, Japan's equivalent to our S&P 500, soared from around $40 to just about $40,000. Overall, it was a fairly consistent climb. Every time there was a dip, it predictably came right back and continued on up. Once again, you could have found yourself with decades of compelling data. This is just what the Japanese market does. It just continues to go up. It always bounces back and reaches new highs. So if there ever was a dip or crash or recession, obviously you should just stay the course and wait for the inevitable rebound. Because over the long run, the market always goes up. Sound familiar? If you've watched the other videos in the playlist, I know it does. Well, it turns out that was the absolute wrong advice for someone investing in Japan in the late 1980s. The market fell more than 80% over the next couple of decades, and today still hovers around half that former high, even though that had never happened before in any developed nation. For that proverbial retiree, this cliched wisdom would have proven her financial downfall. This relatively big risk seems obvious to me, and I hope at this point it does to you as well. So why then do you not hear similar warnings, expressions of concern from other professionals? The answer to that is the financial industry's professional dilemma. Here's what I mean. Warren Buffett and other industry authorities are backed by a horde of financial advisors touting that stock market returns are always positive over any 15-year period statistic. I'm afraid I too helped perpetuate this false sense of long-term security in those I was attempting to serve. And so far, mindlessly staying in the market would have proven lucrative throughout the history of our nation, through numerous corrections, recessions, and depressions. Unfortunately, that fact will attract many experts unable to see it any other way. That is until it is far, far too late. And if they did accept this as reality, what could they do about it? There are no mainstream strategies to counteract these problems. The generally accepted strategies are the problem. Investors, too, will struggle to accept this reality. Psychologically, we want things to be easy. We don't want to feel hopeless. And believe me, I've felt hopeless at times on my journey to finding a better way. This road has been arduous and was incomplete for an uncomfortably long time. There wasn't a clear path. It's taken me half a decade of dedicated research to fully comprehend some of these problems, let alone the potential solutions. Thus, not only would acceptance of this reality by a financial professional result in her not knowing what solutions to recommend, but it would also make it much more difficult to attract new clients. Before she'd even have the chance to try to explain these non-traditional solutions, she'd have the grueling task of trying to help them comprehend this harsh investment reality that goes against an entire industry backed by a body of apparently Nobel-worthy academic work. That's a tall order. It's much easier to just go with the flow, to not challenge the traditional investment paradigm. As Upton Sinclair said, it is difficult to get a man to understand something when his salary depends on his not understanding it. If a practicing professional accepts the potentially ruinous nature of modern portfolio theory, she must either struggle to find and understand better solutions and commit herself to a life of uphill battles convincing clients of not yet experienced dangers, or feel guilty as she continues to push clients into that traditional stock and bond only, buy and hold, plug and play system. A system that is much easier for a financial advisor to make a lot of money in. This is one of the main purposes of my book and these videos. A greater understanding of this reality that everyday investors will demand and actively seek out better solutions, that knowledgeable advisors will be able to spend their time helping those open-minded investors, that researchers will begin to explore even better strategies. But just like the 12 steps of Alcoholics Anonymous, it all starts with acceptance that there is a problem. For the record, this is just one of several issues with the mainstream's buy and hold stock and bond only approach. In fact, this was just one little section from myth 10 of the 16 myths I cover in Stop Investing Like They Tell You. And I think the reason that it hit number 1 on the Wall Street Journal's bestseller list is because I think people deep down know there are some problems with that head in the sand strategy. We're going to keep exploring this. I really want to help you understand it. Here's the full playlist for this one myth. And here's the next video in this series, if it's up yet. But if you want to take a break for a bit to start understanding some of the specific things you can do within your investment portfolio to better protect yourself, better than just sucking it up and staying the course, here's an old video that I think you'll like. I wish you all the best. Take care.